Hello friends, wish you all a very happy and prosperous New Year 2020. Welcome to this January edition of Monthly Viewpoints, wherein we will cover our annual outlook for this calendar year. Now in the past 2 years, market participants have undergone significant pain. The market has remained polarized due to a narrow rally in a handful of large cap stocks, but the broader market has not performed. Now the key reason for this has been a sharp slowdown in the economy, and this has mainly been due to the tightened credit due to the stress in the banking, NBFC and real estate sectors, and tight liquidity post demonetization, GST, RERA and the NBFC crisis, which has especially impacted the SME and unorganized segments. Increased risk aversion has led to the tightened credit, which is the lifeblood of an economy. However, going forward, we believe that the Indian economy has bottomed out and should see a recovery as the worst is likely behind us. We are seeing a coordinated fiscal and monetary response from the government and the RBI. Bank balance sheets are getting repaired and the NBFC crisis is unlikely to become a systemic issue. We are also seeing a gradual pickup in credit growth due to the high surplus liquidity with the banks, which is reaching almost 3.5 trillion rupees. Global liquidity also remains high, and that will benefit emerging markets like India. Overall, we expect the Indian economy to grow at a 6 to 6.25% growth in FY21, which should still be higher than most other major countries. Corporate earnings growth in India, which was depressed earlier, should also pick up in line with the improvement in the economy. For FY21, we are projecting Nifty earnings growth of around 23%. Sectors like auto, pharma, corporate banks and telecom, which had seen a cyclical downturn, are expected to see a recovery. Now, a cyclical recovery should also help to improve investor sentiment, and we are already seeing that being reflected in the market as the indices are already close to an all-time high. Global risk-on sentiment should also continue, which should drive to continuing FPI inflows, and the market valuations can continue to remain elevated ahead of the economic recovery. The recent US-Iran conflict may cause some concerns for emerging markets including India, as we do not have sufficient fiscal space to manage a spike in oil prices. Considering current valuations, the risk-reward is fairly balanced and the returns over a 1-year time frame could be modest in the high single digits. However, long-term investors can expect reasonable returns in line with the economic recovery. Hence, any corrections in the market should be bought into while maintaining a balanced asset allocation. Now, there are still pockets of opportunity in the market. Earlier, we had seen that quality had outperformed and expensive stocks had become even more expensive. However, as the economy improves, we expect that mid and small caps should also start doing well as they have a tighter linkage with the domestic economy. Hence, we believe that we could see a transition from the narrow rally to broader market participation. Select themes of interest remain consumption, especially the low-ticket consumer durables, financials including the private banks and corporate banks, pharma and cement. So overall, we believe that calendar year 20 could be a year of consolidation as the economy and earnings catch up with the markets and transition from a narrow market to a broad-based market participation. Thank you, and once again a very happy new year.